You're listening to Uranium Spotlight, brought to you by Purepoint Uranium Group, your exploration partner in the most prolific areas of Canada's Athabasca Basin. With a collaborative investment model on district-scale projects and validation from industry leaders Cameco, Orano, and ISO Energy, Purepoint is investing in Canada's uranium future. And now your host, Chris Frostad.
This week on Uranium Spotlight, spot prices climb on financial buying. The EU faces a tightening fuel future, and Saskatchewan miners hold strong through wildfire season. The uranium spot price rose again last week, closing at $78.75 a pound, up $2.25 from the previous week's $76.50. That caps off a strong three-week rally that added more than $8 to the spot price since early June. This latest move was again driven by financial demand, particularly the Sprott Physical Uranium Trust's re-entry into the market following its recent capital raise. With new cash on hand, the trust resumed physical uranium purchases, triggering a flurry of activity that helped push prices higher. Spot market volumes remained strong, with over 21.5 million pounds transacted through the end of May, up roughly 7% year over year. Utility buying has picked up considerably, accounting for 8.7 million pounds so far in 2025, more than triple the utility spot activity in the same period last year. That said, we're still operating in a tight and fragile market. The long-term price closed June at $80 a pound, which continues to anchor utility contracting decisions. But the disconnect between spot and term pricing has narrowed, and that could influence carry trades and incentive pricing in the months ahead. Geopolitical risk remains a key factor. Ongoing discussions around Russian sanctions, questions over production timelines, and restarts continue to shape sentiment. For equity investors, this is a supportive backdrop. Rising spot prices tend to pull juniors off the floor, especially those with real assets or JV backing. But as always, volume and staying power matter more than a single price print. If you haven't already, be sure to subscribe to Uranium Spotlight podcast, available on your favorite podcast platform or on Purepoint Uranium's YouTube channel. The Uranium Supply Agency released its 2024 annual report this week, providing a detailed look at uranium supply and demand across the European Union. According to the report, the EU currently accounts for about 20% of global uranium purchases. If it were a single nation, the EU would actually oversee the largest fleet of nuclear reactors in the world, more than even the United States. That said, the US still leads in uranium purchases and maintains significantly larger strategic stockpiles. EU stockpiles currently sit at around 88 million pounds of U3O8, while the US holds about 152 million pounds. China, by comparison, is far ahead with a massive 264 million pounds in reserve. Interestingly, the report forecasts a gradual decline in uranium demand within the EU. Several factors are contributing. Aging reactors are being retired without replacement, fuel efficiency in new reactor designs is improving, and the use of alternative fuels like mixed oxide is increasing. In 2024, EU uranium demand was around 30 million pounds. From 2025 to 2034, that number is expected to average 28 million pounds a year. But by 2035 to 2044 period, it could drop to roughly 19 million pounds annually, a 35% reduction over 2 decades. But for investors, this isn't a bearish signal just yet. Despite the projected drop in reactor consumption, the real story may lie in stockpiling. In 2024, the EU effectively consumed as much uranium as it purchased. It didn't grow its reserves at all. In today's geopolitically uncertain environment, that's a risky position. The Uranium Supply Agency is now urging all EU utilities to maintain a minimum of 3 years' worth of uranium inventory, and preferably more. Currently, EU stockpiles cover about 3 reload cycles, but if members act on this new guidance, we could see significant near-term buying pressure. That buying would be less about long-term reactor demand and more about national energy security, a theme driving uranium purchases globally. For uranium investors, this highlights an important dynamic. Short and medium-term demand can rise sharply even when long-term reactor forecasts flatten. If the EU begins aggressively rebuilding its stockpiles to match US or Chinese levels, it could inject substantial new demand into the spot and term markets, supporting uranium prices and potentially lifting uranium equities. How easy will it really be for another buying frenzy to take hold? especially now with growing concerns over security of supply. In 2024, natural uranium imports from Russia and Kazakhstan to the European Union dropped to 40% of total supply, down from 46% the previous year. That's a meaningful shift. At the same time, supplies from African nations, particularly Niger and to a lesser degree Namibia, also fell sharply, from about 16% in 2023, equivalent to over 5 million pounds, to just over 9% this year. That missing 14% had to be made up by more geopolitically aligned suppliers like Canada and Australia. These trends are not isolated. Heightened geopolitical tensions, whether between Europe and its former African colonies or NATO and Russia, are fundamentally reshaping uranium trade routes. In 2024, Canada supplied 33% of the EU's uranium, while Australia delivered 10%. Combined, they've now overtaken Russia and Kazakhstan as Europe's primary uranium suppliers. And this east-west split in the uranium market is gaining momentum. Western utilities are increasingly turning to Canadian and Australian producers, while Russian, Kazakh, Uzbek, and African supplies are flowing towards China, India, and other Eastern buyers. Interestingly, Euratom's 2024 figures show that 4% of Europe's uranium imports came from China. But with China producing only about 3 million pounds annually, that 4% could represent nearly a third of its entire output, an unlikely scenario given China's growing domestic reactor fleet. So what explains the numbers? One possibility is that this material isn't Chinese at all, but rather Russian uranium being funneled through Chinese intermediaries to obscure its origin. A similar workaround was suspected in the U.S. last year following the Russian uranium import ban. That led to the Biden administration to impose new tariffs on Chinese uranium. Euratom has made it clear, phasing out dependence on Russian uranium and nuclear fuel is now a strategic and political priority for the European Union. For investors, this shift signals continued fragmentation in the uranium market, and with it, new pressures on Western supply chains. This realignment supports higher prices for secure, reliable production, particularly from Canada and Australia. In short, the squeeze on Western supply is very real, and it's only just begun. The outlook for European utilities trying to secure uranium isn't encouraging. Right now, most have contracts in place that cover somewhere between 70 to 90% of their uranium needs through to 2032. The remainder is expected to come from the spot market. But beyond 2032, things could get much more uncertain. Looking at 2033, coverage drops off dramatically. Even on the high end, only 45% of uranium needs are expected to be secured. On the low end, it could fall to just 38%. And with only about 3 years' worth of uranium stockpiled today, that shortfall starts to look serious. At the same time, European utilities are facing a shrinking supplier list. Access to uranium from Russia, Kazakhstan, and many African producers is either politically constrained or becoming strategically off limits. That leaves utilities with few options and little time. The reality is, contract coverage is just holding steady until 2033, and then it collapses. If Europe wants to keep its nuclear fleet running, and let's not forget nuclear currently supplies 22% of the EU's electricity, utilities will need to start locking in supply now. No operator wants to risk having a multi-billion-dollar reactor offline simply because they didn't secure fuel in time. For investors, this means continued and intensified demand for long-term uranium contracts, and potentially more aggressive buying from utilities in the near term. As coverage gaps grow, the pressure on both prices and producers is likely to increase, giving uranium equities more room to run. Northern Saskatchewan's uranium miners have once again demonstrated their ability to navigate operational risks, this time facing a particularly aggressive wildfire season. While fires in late May triggered road closures and cut power and communications, companies like Cameco and Orano say they remained operational thanks to years of preparation and experience. Cameco, which operates Cigar Lake and McArthur River, maintains on-site fire breaks, emergency sprinklers, and has over 160 trained personnel to manage wildfire response. COO Brian Riley noted that past fires, like the 2021 Briggs fire, sharpened their response protocols. This year's fires didn't directly threaten facilities, but supply routes were disrupted, requiring careful inventory management and reliance on backup power and satellite communications. Operations also had to adjust staffing as employees in affected communities returned home. Despite all of this, Cameco remains on track to meet its 18 million pound production target for 2024. Orano Canada, which runs the McLean Lake Mill, processing Cameco ore, face similar logistical issues, but also continued operations, using truck convoys and generators to stay on track. Even developers like NextGen Energy are proactively planning. CEO Lee Currier said their Rook 1 project, slated for full approval in 2026, has been mitigating fire risks since 2013 and will continue to do so. What's this mean for investors? These disruptions reinforce the need to factor in climate-driven risks like wildfires, but they also highlight the resilience of Saskatchewan's uranium infrastructure. For investors, the message is clear. Even amid escalating environmental volatility, Tier 1 operators in the Athabasca Basin are proving they can deliver. And that wraps up your Uranium Spotlight coverage for this week. For more news and events from the world of uranium, please tune in next week to Uranium Spotlight.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to delivering the latest news and events shaping the uranium fuel market and its critical role in the global energy landscape. Brought to you by Purepoint Uranium Group. Purepoint actively operates a portfolio of advanced uranium projects in the world's richest uranium district and has established partnerships with industry leaders. While our passion for this subject is undeniable, it's essential to clarify that the information presented here is not investment advice. Instead, our goal is to offer an unbiased and comprehensive review of recent events that could impact uranium prices. Join us again next Tuesday for Uranium Spotlight.